Welcome to another episode of the Obsessed with Real Estate show. I am your host, Alana George, and I'm obsessed with real estate. Today, I have for you a webinar we did on cost segregation and bonus depreciation with Bill Smith with ELB Consulting. It was a great turnout and a great informational webinar. I've been hearing right and left about cost segregation, bonus depreciation. It's slowly disappearing. It's something real estate investors have been taking advantage of. And I needed to get more information. So I hosted a webinar on it, brought in a professional on it to present to you so I could learn. I hope that you find value in this. Bill does a great job presenting. It would be helpful if you were able to watch this episode because he does have slides. He doesn't do a great job of repeating the questions that were submitted via the chat box before answering them, but that's okay. I'll give him some slack on that. And he has some cool analogies that you have to check out where he relates cost segregation to like dissecting of a building, like you dissect parts of the body, which sounds super gross, but it's not gross if you're going to watch it. It just means like nervous system, skeletal system, organs, muscles, anyways, as well as he relates it also to dissecting a Big Mac. So that might be more tolerable. You'll just have to see it. He goes into what is cost segregation, why it's beneficial, and some real life studies or case studies comparing straight line depreciation versus bonus depreciation via a cost segregation study. He is available to reach out to with questions, and you can grab his information at the end of the show. I hope you enjoy.
Thank you, everyone, for joining us tonight to learn about Cost Segregation 101. Very exciting how to save more money on your taxes this year with our guest, Bill Smith with ELB Consulting. He works with commercial real estate developers, owners, and investors to reduce their federal tax burden and increase their cash flow through cost segregation and other specialty tax solutions. ELB Consulting has been able to work with some of the nation's industry-leading companies over the course of 14,000 cost segregation studies, which is amazing. Needless to say, he's an expert, a specialist, and we are so honored that he's joining us tonight on this podcast to share with you these wealth building tactics, which is what Elsa and I strive to do, right? We're building wealth through real estate, and this is definitely a must do if you're looking to build wealth and generational wealth. So thank you so much, Bill. Take it away. I'm going to make you host now.
Right. So we named it Cost Seg 101. Knowing the audience here, not sure, we kind of go to the fundamentals. And as you guys have seen, it's really how to pay less taxes, how to save money. And everybody's heard about cost segregation, or I mean, people call me every day going, hey, I just heard about this. So I help people with single family rentals and, $100 million multifamily apartment complexes, hotels, manufacturing, and everything in between. So the first thing we like to say is legal disclaimer. I'm not a CPA, for your own situation. Everybody's tax, your return is your own. And so there's a lot of implications there, but cost segregation is a tremendous deduction to really help you reduce your tax liability. So, but again, I'm know a lot about this, can help you any way I can, but always confirm with your tax professional, your CPA, tax attorney. But the key thing is cost seg is not a loophole. It's an IRS guideline that was established really through the 86 tax law that was passed and made some significant changes. But, IRS put out a quote, Journal of Accountancy put out a quote, cost seg is not a tax shelter. It's a specifically defined and guided IRS tax reduction tool. So, everybody should be doing this. If you've got commercial real estate, whether it's a Airbnb, short-term rental, and you're using the short-term rental loophole, or you're a real estate professional and you're buying multifamily or retail or whatever your niche might be, it should be used to reduce your taxes, should it fit with your tax strategy. So, this came about in 2000 or in 1986, but people were using it. There was lawsuits. So in 2004, the IRS established an audit techniques guide. So how they would what they would do if they were to audit you. Now, so there's a little bit of this is some background. I'm kind of establishing the foundation of cost segregation for you. Then we're going to talk about some details, and I'm open to questions. You can put them in the chat box. I'll try to get to those afterwards, I guess. But because there was lawsuits and details, they kind of established different guidelines for this. In the tax code itself, cost segregation is not mentioned. It's just, it's a way of segregating the components and short-lifing certain components of your building to make them, a faster, accelerated, depreciable life, which gives you greater deductions. So they define 6 methodologies. Our firm uses the top 2, whether it's a, actual cost of new construction, or we use a PPA called purchase price acquisition, which most people here are probably doing, buying a home, buying a building, buying an apartment complex. We have to then go back and apply costs to those, but using a detailed engineering approach. Other folks are using surveyor letter approach, residual estimation, modeling and sampling. We actually have a modeling tool for small properties, and rule of thumb, which is basically a swag, which many probably know that's a scientific wild ass guess. So, if you get audited with that, you're coming to us to get you out of it. Now to the point of this. What's the purpose of a cost segregation study? So what we essentially do, we got little pictures here, but we break down the property into its component parts. I mean, all the roof, the doors, the windows, the flooring, the appliances, cabinets, lighting, window treatments, everything. And by doing this and changing the taxable life and kind of giving a reclassification of those life, because on a residential, you might know it's 27.5 years. Buy a house, divided by 27.5, you're renting it, and then that's your depreciable life. However, what cost segregation does is go into certain components of that building we identify and reclassify that life into 5, 7, or 15-year life. So this basically optimizes your depreciation schedule to leverage the time value money, meaning it takes these life and brings it forward. So these deductions you're allowed to take, a tax deduction, depreciation on what normally would be an appreciating asset, right? Real estate is, notoriously known as an appreciating asset and a wealth builder. So you can depreciate that, take these deductions, take the short life deductions to offset your tax liability on the income generated from your property. And in certain cases, if you're a real estate professional or using a short-term rental loophole, you can offset your ordinary income, which is what most of my clients are doing. So, some people will call it an interest-free loan from the IRS. So essentially you're not paying the IRS money. I've got an example for that later, and using that, but it's still taxes you always have to pay. The IRS is going to come get you at some point. Will always come due. And so how do you benefit? Well, you got to be for profit, and you need to have a tax liability or anticipated tax liability. If you're a nonprofit or you are not making money, and you don't have any need for tax deductions, it's not really going to help you. So how do we do that? So folks that are into science and in school, you love biology and dissecting frogs and all those things. I'm going to turn off my camera. I kind of broke this down and saying, how do we really do? We break down a building into its components. And I just thought about this stuff from biology class. I really wasn't that good at that, but we're essentially breaking it down. The skeletal system, straight line property, external walls, structure, doors, things like that, muscular system. These are the accelerated components. Really have straight line, which is just over the course of the life, whether it's 39 years or 27.5, and accelerated, whether this is going to be 5, 7, or 15-year property. So your muscular systems are kind of demountable walls, partitions, things like that. Nervous system, specialty electrical. You need general electrical. You need general components, general lighting, windows, doors, walls, ceiling, HVAC, bathrooms. Now, specialty HVAC for computer rooms, things like that, that's a short life option. So these are kind of one way to look at how we break down a building when we do a cost segregation study, kind of from a scientific method, dissecting it, applying a different life to those components, and then calculating your deductions. Now, if you're not into science and you like hamburgers, we have a Big Mac analogy as well. So at a Big Mac, straight line method, you've got a Big Mac, but straight line method, you look at it, it's just a plain burger. There's nothing, there's no special sauce, lettuce, cheese, pickles, onions on a sesame seed bun for straight line. It's just all the part, no specific parts. It's either going to be 27.5 years for a residential long-term rental, or 39 years for commercial property or a short-term rental, which a short-term rental is classified commercial property if you have an Airbnb, because it has the transient tax that you pay in addition to, like a hotel would do. Now, cost segregation, when it sees that hamburger, it breaks it all down in its component parts, and then it gives different life classes to this. So it's just a way to kind of demonstrate how cost segregation breaks down a building into its components to accelerate depreciation, to create tax deductions. So these tax deductions, it functions essentially like itemized deductions or your standard deduction. When you have your income, you have this big deduction, it just offsets your income. It reduces your income through deductions. So how does it provide tax benefits? So essentially you're accelerating these tax deductions, as I mentioned, this depreciation, to increase your cash flow, and your cash flow is increased because it reduces your tax liability. Again, I've got a chart in the back that kind of says, well, if you're not paying the IRS, you're keeping that money in your pocket to invest in more properties. Let's see, there's a Q&A thing here. Chat is disabled. Okay, that's not to me. So it drives me crazy to see that. Let's see, what do we got here? So, and everybody's heard about the Tax Cuts Jobs Act or bonus depreciation. So many people have gotten into the industry, in the past few years because of bonus depreciation and all the opportunity that it delivers here. So again, cost segregation is a tax strategy to accelerate life components, which creates tax deductions, which the goal is to increase your cash flow. So by increasing your cash flow and paying less taxes, you can buy more property or upfit your property, things like that. And then we're going to talk about bonus depreciation and really what that is. Everybody's heard about it, not exactly sure what that is. Some people are fairly sure what it is, but I'm going to, I'll be able to answer questions afterwards, but hopefully this will get this taken care of. So
Bill, can I interrupt you for just a second?
Sure.
I'm sorry. I just want to let everybody know, for some odd reason, the chat is disabled, but there should be a Q&A button down at the bottom on everybody's screen, and you can put your questions in there, and that'll help us facilitate the Q&A at the end. So you can send those at any time in the Q&A section, not the chat. So I just want to clarify that before you proceed.
Yeah, and I see this, there was a question here about a solar. So solar would be an accelerated component. Usually it's going to fall into a 5-year, but there's different classifications of how that would be, whether it's a solar field or it's on the building or things like that. But usually we will itemize that, and it is broken down, and it would be accelerated, have an accelerated life. It would not be straight line like 27.5 years. So the Tax Cuts and Jobs Act, which was passed in February of 2018, established bonus depreciation at 100%. Now, we've had bonus depreciation before at 50%. It was 100% once, I think, in 2001, but it was always on new construction only or new improvements. So it wasn't on what the IRS added or what the act added, a used property or acquired property. So now with acquisitions, you can apply bonus depreciation. And so that really changed the game for real estate investing for so many people, because it wasn't just for new construction and builders and developers, it was for anybody acquiring property. So established at 100%. And so it went effective, even though it was passed in 2018, it went effective back to essentially the fourth quarter of 2017 through 12/31 of this year. And that's for 100% bonus. But then there's a sliding scale that starts to tail off. And in the next slide, we'll talk about that. So it gave this 100% bonus up until 12/31 of 2022. So if you bought a property and let's say you spent $200,000, or let's say $250,000, your land is allocated at 50, so you've got $200,000 depreciable basis, and we identify 25% of that property as accelerated property, then 250 or 200 times 25% would be 50,000, and that 50,000 would be a deduction you could take in year one. So bonus means you can take it in year one. All the 5 and 15-year property that you would normally accelerate over 5 and 15 years, as we've been doing since we've been doing business since 2002, you can take in year one. So it gives you this extremely large deduction. So that's what bonus depreciation is. And so it kind of changed the game for real estate investing. So it's not extra. You don't get more. You don't get like double depreciation. It just means anything less than 20-year life that we assign would qualify for bonus depreciation and allow you to take that in year one. So there's other life classes besides the typical 5, 7, and 15. 10 years for agriculture. So if someone had a greenhouse and was growing lettuce or tomatoes or things like that, strawberries, then of course the greenhouse is agricultural, does really well as well. It's a 10-year life for anything agricultural. Wine, big out there in California. So let's talk about an example of how it actually works. So I just like to do a simple example, 2.75 million. So 27.5 obviously divides into this number really well. So without cost segregation, and you bought an apartment for 2.75 million, that's your depreciable basis. So you would have bought it for more because you have to take land out. Raw land is not depreciated. So as I mentioned before, you paid 250, 50 is allocated for land, then your depreciable basis is 200,000. In this case, the depreciable basis would be 2.75 million. And so you would write off $100,000 per year in tax deductions. And if your income was, after all your expenses, $100,000 per year, you really wouldn't need cost seg because this would pretty much cover up your deductions. However, people are using it against ordinary income. They've got other needs for that. And so typically you're going to want, cost segregation. But $100,000, we multiply that times, 0.37 tax bracket, 37%. So essentially the cash value of this $100,000 deduction and just straight line depreciation is $37,000 per year that you're not paying the IRS, that you can use for other purposes. Now, with cost segregation, if we only found 25% on this property, usually we find more, but I want to be conservative, 25%, then the bonus depreciation is $687,000 in year one. 0.25 times 2.75, 687.5. And then you'd also still get if you reduce that, you'd have a little over 2 million that you would still carry out as straight line depreciation. So essentially, if you took that 687 in year one times 0.37, that's $254,000 plus in net cash benefit year one versus 37,000. See, that's the power of depreciation. You're not paying taxes. You multiply your deductions by your tax bracket, whether it's 37 or 25 or 32. Most people might be in this tax bracket, but with depreciation, they move themselves way down the tax. And some people don't pay taxes because of depreciation. A lot of real estate investors, that's kind of the goal for real estate investors, is to not pay taxes. I think that's why we're all here today. So that's a quick example of how that works. I hope that kind of gives you a quick idea of the power of cost segregation and the difference that you've got from $37,000 in year one, which would be every year, to $254,000. Now, you would still have a pretty significant tax deduction from your straight line, but your straight line here would go down to $70,000 per year, right? Or 25, actually 25% would be 75,000 per year. So that times 0.37 would be, 30, 29 or something like that. So you still have a pretty good deduction. Excuse me. But this is why people are doing bonus depreciation. Whoops, went a little fast here. All right. So changes, you've probably heard about it. It's kind of going down. Where's my scroll? Okay. So the changes here. All right. I'm having problems, technical difficulties here. Let me scroll here. There we go. I thought I had a different slide on the. There we go. I went too far. Okay. Bonus depreciation. So as I said, it's 100% through 2022, the end of this year. Then it reduces by 20% annually until it gets back to zero. So next year in 2023, it's 80%. So if you got $100,000 in bonus depreciation this year, next year it'd be 80, and that 20% would still be divided and allocated over the next 5 and 10 years. All right, let's see. Open. Let's see, I don't know. I understand what the CA doesn't allow, accelerated cost savings with straight line. I'm not sure I follow that question. Maybe clarify that. I don't know the CA. I don't know what CA does. The CA didn't allow.
California.
Oh, California. Yes. Federal taxes. Exactly. CA. Yeah. I'm in VA, so I used to be in AZ, and so yeah, okay, duh. Yes, of course. Yeah, California doesn't allow bonus depreciation. You can use regular depreciation, but on your federal taxes, you would apply this depreciation, but California doesn't. So there's some tricks there, and there's other states don't. North Carolina doesn't. A bunch of states at the state level don't allow bonus depreciation, but this is really for your federal taxes. So from your federal taxes, it does, and a lot of that carries down into your state calculation. So taxable 1031 exchange. Okay, I'll get to that. Let me answer a couple of these questions. Let me get through this slide and I'll talk about that. So, next year it would be 80%, the following year 60%, next year 40%. So, and through 2027 is kind of when it goes away. But accelerated depreciation does not go away. Our company's made a living on accelerated depreciation since 2002. So bonus depreciation just really kicked in the end of 2017. So it is still a tremendous benefit to take advantage of that. And people have been doing it since 1986. So it just went on steroids when President Trump set up that Tax Cuts Jobs Act. So here we go. In regards to a 1031 tax exchange, you can cost seg when there's a 1031. However, a 1031 is already deferred taxable funds. We'll do a 1031 for deferred funds. So again, I like to do simple math, and I'm not going to do all the other depreciation components. You buy a house for $100,000, you sell it for $200,000. There's a $100,000 gain. You say, I don't want to pay taxes on $100,000. I'm going to do a 1031, and you're going to roll into a new property, and you roll into a $500,000 property. Okay, so when we do cost segregation on that $500,000 property, you take the $500,000 less your land allocation. We'll assume that's $100,000, 20%, less your 1031 funds because it's already tax deferred. So now we're going to depreciate $300,000. So you take out your land and you take out your 1031. If you bought a $100,000 house with that $100,000 gain, you can't do cost seg because you've already you can't double dip with the IRS. I hope that answers your question. So we do a lot of 1031s. We've got to get the depreciable basis from the CPA. We don't determine that, but so it is available, but it does take away because a 1031 is already deferring taxes. So cost segregation does the same thing. It's better in many cases because you don't have to do all the tracking and going on for years and years. If you're building generational wealth and want to pass it on to your kids and get to step up in basis, it's absolutely good. So 1031s are great for the right reason, but just to avoid taxes, depreciation, has other methods to do that just to avoid taxes. So it's always good to think it through completely. I hope that helps. If you do cost segregation and take large deduction in year one, but you don't have enough income in year one, can you roll? Yes. So great question. And I'm gonna get to that one coming up here in future years, Julio. And then Tony has one. What asset classes can you depreciate most? Car wash, self-storage. Great question. I have a slide. I didn't really have that, but a car wash is great. A car wash could actually all qualify as 15-year. And since it's all qualified as 15-year, then you don't have to do cost segregation. It does really good on cost segregation, but with 100% bonus, you can take the whole purchase price of your car wash in year one. Same with a gas station. As long as a gas station, 51% or more of the revenue is derived from petroleum products. And then of course, there's things about how much floor space and different sizes, but generally if it's petroleum products, which would include sale of oil and, windshield wiper, things like that in the convenience store, the whole thing qualifies for 15-year, and you wouldn't need you wouldn't need cost segregation because you can just take it all in year one now that there's 100% bonus. As this trails out, then of course that will change. Multifamily does really well. Self-storage does great. I mean, just the old traditional garages, freestanding buildings, single story, cement things with the demountable, they got wall partitions, do well. But an air-conditioned self-storage, multi-story, excuse me, it's like a tickle in my throat. They do extremely well. So it depends. Every building is different, but buildings with a lot of building bling do well. A Starbucks, a freestanding coffee, or you guys are out there. We had Dutch Bros in Arizona, and Dutch Bros is big. Those freestanding ones where they got curbing and I've seen them get 70% depreciation in some of those properties because it's all specialty plumbing, specialty electrical, curbing, and you get just a simple shell of a building. So there's a ton of benefit in those. But an Airbnb, a nice home with a pool and nice amenities, they do very well. They do very well. So hopefully that helps. But, a car wash or a gas station, I mean, they would be the greatest because you don't even have to do cost seg. You could actually take 100% through the end of this year. Next year, it's going to be 80%. So it's going to change. Let's see. Next slide. As I jumped a slide ahead, I think I skipped this one last time. So now we're going to try. This is the example I was talking about, and this is really going to answer your question. So really, how does it work? Just simplify. I mean, I've talked about this for years, and somebody wrote this. I'm like, oh, duh. I went through this for years, but really, if you acquire a building for $2 million and you get 25% bonus depreciation, right? So that's a $500,000 tax deduction. But in that same year, you had $250,000 in income. So the result for your tax filing is a $250,000 loss. Okay, so you've got $500,000 deduction, $250,000 in income, but when you report on the IRS on your schedule, it's actually a loss. However, you still made money and you still got net cash. So your rental income is $250,000, your depreciation is $500,000. Now you've got a net operating loss or a carry forward loss of $250,000. Even though you've lost money on paper, in reality, you did not lose money. And that $250,000 carries forward to next year. And you would still have your straight line because you'd have 1.5 million here that you're depreciating over 27 and a half years if it was an apartment, or 39 years if it was an office building or something. By the way, doctors' offices and dentists and things like that also do very well for depreciation because of all the built-in components and things. So that's how this carries forward. And then it would just carry forward for up to 19 years. So you never lose it. And the other key thing is say, okay, and now we sell it. And a lot of people have not, I thought I'd see the recapture question, but if you sell it, then any unused, depreciation, and you sell while you still are carrying forward some depreciation, that can be used to offset your capital gains. It kind of unlocks it from being a depreciation deduction into offsetting your capital gains on your real estate. So it's a passive activity. Depreciation is a passive loss, which goes against the passive income, which is essentially rental income, unless you are a real estate professional, which means you spend 750 hours a year dealing and managing and being an active participant in your own real estate. Doesn't mean you're a broker or anything else. It just means you're an active participant in dealing with your real estate, and it's taking at least 51% of your time. So you've got to do it more than anything else. So if you've got a W-2, which is I think 2,031 or 2,032 hours a year, if you're doing 40 hours a week, and then you say, I'm going to be a real estate professional as well, the IRS has busted a lot of people on that because you can't spend 2,033 hours in addition to the other 2,032 hours on your job. You just usually there's not enough time in the day. So that's why a lot of people now, there's a thing called the short-term rental loophole. There's a class out there, the tax advisors. I don't know, I'm even on that class. People are calling me all the time for that. But if you have an Airbnb, you only need to spend 100 hours managing your rental property, and then you can use that deduction, this depreciation, against your ordinary income. So with a real estate professional status or short-term rental loophole, these tax deductions can be used to offset your ordinary income. So usually I've got a lot of clients where one of the spouses is a high earner, lawyer, doctor, something. Other spouse is buying and managing real estate and taking those deductions because they're on a joint return and offsetting that ordinary income. But it's got to be just one person doing that. You can't split those hours between two of you. So I think I had another question. Can we see the questions, other people's questions? I don't know. I don't have to do that. I don't know that it shows all them all.
Yeah, I'm not sure why the chat is disabled. Maybe you as host, if there's a way that you can disable that, or if I accidentally did that, I don't know, but I can.
Actually, chat's open now. Chat seems to be open now. I just clicked on it. Before it said disabled. So now
Well,
let's
I can
open.
only message you two, so there's not an option for me to message the group, but I can share the questions because I know they're downloadable after the fact. Otherwise, Bill can continue reading them aloud.
Yeah, I've kind of, I think I've been answering, there's been 5 here. So that's most, and then the last one was, can we see other people's questions? So I've been going through them and answering those. Here we go. Ta-da! I just drag it over to my other screen. So here's the questions that we started out with. The California question, then allow accelerated, correct, but your federal tax return does. 1031, we answered that. 1031 does impact your depreciable basis. It's reduced by your deferred funds. So in that example where it was a $200,000 home, or you sold it for 200, still only 100 was your capital gain. So 100 is your deferred amount, not the 200, because you had a basis of 100,000 in that one. So that's important to know when you do your 1031. Take a larger year one, it carries forward, as we talked about here. It's a net operating. You don't lose it. It will carry forward for up to 19 years. I talked about the ones you can do most, and there's the other people's questions. And if you have a duplex, can you cost segregate one unit and straight line the other second unit? We have a 1 unit Airbnb and the second is long term. Yes, I've done it with folks where they've lived in one side, and not that we've kind of, you've taken it, you basically split if it was a $200,000 property, you just say 100,000 for each. You would then you have to allocate part of the property and be on your depreciation schedule, allocate part of the 39-year and short-term rental, and the other would be 27.5 year for long-term rental. Some people just do it as one. If you're living in one unit, then it's different. You just do one unit. So here, that's kind of a CPA question. There's a lot of ways that it might be addressed, but it can certainly be done. And our technology will certainly allow you to do that. Can I cost segregate an ADU on my primary resident in California? So ADUs are going like crazy, this thing. And what is it? What's an acronym for? ADU, what's it stand for?
Accessory dwelling unit.
An accessory. So is it like those little, is it like those, small homes and things like that? It's like is it modular?
Yeah, like a granny unit, or some places call them casita.
Yeah, like a casita, or it's like, well, we always call them a casita in Arizona, or now there's a lot of people are putting in these small homes or micro homes, or putting something or building something. So yes, you can definitely do that. And in California, again, I don't know the California laws that you can do, but we can cost seg those particular properties. And I don't know if you allocate land towards that, it would be done just like a condo. We would say, okay, how much did you pay for it? What'd you do? And so there's a definite way to do it. I've done a lot of people with ADU. Sometimes they'll do the ADU as well as the rental home, and they might have a long-term rental and a short-term ADU, or both short-term. And then we just do it as a duplex. It'd be on one property. We calculate it just as 2 unit property. So it's like a 1 to 4. So there's different ways to address that depending on the circumstance. And so I'm not sure about in California laws, what it's going to limit you to. So that's again up to your CPA. I'm going to call after coming in. If we own the 15 years, have we had cost? You can go back about 15 years if the purchase price is big enough. But if it's pretty much too late. If you're looking at a home, let's say, well, you're in California, it's $1 million home. You can go back, 5 years or plus. And really, I tell people now, if they're looking at homes, go back to bonus depreciation when it started, the fourth quarter of 2017. I mean, it's called a look back study and a catch up study. So all these components that are 5, 7, or 15 years have been depreciated for 27.5 or 39 years. And so you can go, you say, well, it's been a 5-year property, it's been 5 years, it's been depreciated. No, because a 5-year property that would be reclassed has been depreciated for 39 years or 27.5 years. So it brings all that depreciation forward. It's called a look back study. It catches it up. You don't have to amend your taxes. There's a form called the 3115 change of accounting method. You're telling the IRS we're changing our accounting method from straight line to component level depreciation. It's automatic approval. Other accounting method, require IRS approval. This is automatic, it goes in your form. We do it all the time for clients to go, hey, I just bought a property last year or 2 years ago. I didn't know about this. And so now they're doing it. We do it all the time. But 15 years, you can only go back 15 years because that's, the short life depreciation. And, and at that, to go back to how you need to be several million or more to kind of have it gather enough depreciation to make it worth your while. Granny flat, there was an answer to that. Cost variance worth. Is it worth $100? Yeah, I do this on homes that are, $100,000 or less. So yeah, $285,000. I look at the land allocation. Let's say it's $200,000, and just at 25%, that's a $50,000 tax deduction you can take for short term. So if you're doing the short term rental loophole, yeah, I do small properties all the time and I'm going to explain the system we do for that. Now, a full study might be overkill, but we have an option on there. And I know
Bill, just to interrupt again, for any future questions, go ahead and read the whole question aloud, because you're not screen sharing the Q&A. I think that you are, but
it's on my screen.
So if you want to just read the whole question aloud, that would be really helpful. No worries, just future questions.
There, I can now. I think I should. I just had shared my PDF. So hopefully now you can see it. But yeah, for future questions, fourplex in 2020.
Just go ahead and read it aloud. Mm-hmm.
Yeah, fourplex in 2020 will be able to go back and do a cost seg also in California. Yes, you can, and it'd be federal benefit, but California you still have depreciation. But yes, you can do a fourplex in 2020. Absolutely, you get 100% bonus depreciation. I do this, I think I did one today for 2020 for somebody. So I'm going to jump to the next slide, which really I'm going to move this over here for now till more questions come up. And I apologize, I didn't realize I wasn't sharing that. I mean, I was looking at it on my screen and it seemed obvious, but anyway, you may have heard, may not have heard, we've been doing this since 2002. We've done over 15,000 studies. As Alana said, 14,000. That wasn't updated, it's probably from our website, but no, we've done over 15,000 studies. And so about 4 years ago, we said, let's build a modeling solution for single family rentals, smaller properties under $1 million. We've since gone up to $3 million, but this has been going gangbusters. I do quite a lot of these. I've been on some podcasts and things like that, promoting this. The real estate CPA promotes this like crazy. I get calls all the time, even on their short-term rental class. They've got a special session with me. People are calling me, hey, I saw you on Tax Smart Investors. So anyway, it's a low-cost solution. It's instantaneous. It's a modeling solution. As I mentioned in the beginning, one of the solutions that the IRS has approved is modeling. So this is modeling. We've used our data on 15,000 studies to model properties. And it's really very effective tool. And again, it goes up to 3 million. But if you have a house or a property that's over $1 million or $1.5 million, I look at that to say, is it worth doing the lower cost solution? It's instant, it's fast. If you're in a hurry and you wait to the last minute, we can get it done. But there might be circumstances where it's going to err a little conservative because we're not inspecting it. So we could possibly consider doing a full study, because we might say 5% more, 5% of $1 million is, $50,000 if you're mining for deductions, and the price differential is, $3,000 or $4,000. For $3,000 or $4,000, it might be worth, that to get an extra $50,000 deduction. It's fully defended. If you get audited, we fully defend it. It starts at $640, and that's with audit defense. And I've got a $50 coupon for residential for a 1 to 4 unit. So the 1 to 4 unit that Joe, you brought up, or somebody had a 285, it covered this. For $640, we'd do it. And I help you do it. It takes about 15 minutes. And then if you got a 5 unit or more, which is commercial property, or, self-storage, doctor's office, flex space, it starts at $1,390. So it's a great solution. It's quick, it's easy, and it actually is right here. DIY cost seg, get your report, rental home condo, you key in certain data points, fields pop up, but your building grade, pick the building type. Here's a duplex or condo, single family home, baths, appliances, countertop material, flooring by percentage. It's very simple to do. So I've got my full screen shared. You can see that, correct, Alana?
Yes, thank you.
Okay. Yeah, I share the whole thing. So that's what that one does. So it's a great tool. I help people with that a lot. I usually step people through it, and then you pay for it with PayPal or credit card, debit card, and you have your study in minutes. So it's a great tool, again, for smaller properties, for short-term rentals. I did one for a guy for $900,000 short-term rental in North Carolina Beach just yesterday. Just a little bit about us. I'm going to look at more questions, but ELB's been around for 20 years. We do a fully engineered and accounted study. No one really does that, but us. There's a couple that out there, but most people are using other methodologies, which are called engineering based, and they cherry pick and they just leave money on the table. So we usually find between 6 and 15% more than the national competitors that we've looked at them, we've audited them, we've redone their studies. We also have a project management team, so we really focus on service to be best in class. So we manage it, get it going. So if you do work with us, DIY is done, you work with me, but if you really were doing full cost seg, we work through this. And so, cost segregation is expertise of engineering, accounting, and construction. So we bring all those, disciplines together to really produce a solid report. We throw some big clients out there, big names, people I recognize, but that's really what I had for today. And I think I went a little longer, but let's see. A lot of thank yous there. A lot of thank yous. Let's see. I have several single properties bought over this country. Yes. So you bought several single properties. I got a client that did that in Texas recently, and they've got like 10 properties, and they bought a few recently. And they're not a real estate professional, so they can't use the income against ordinary income. However, I said, well, let's just do 2 or 3 properties, the most recent ones. And then, because you got, let's say 12 properties or multiple properties, the most recent will give enough depreciation to offset the passive income from the other. So if you're making money, so you look at, okay, I'm making $25,000 a year on these properties. If I do a cost seg on one of them, I might get, $50,000 for the deduction. So maybe if I do 2 of them, I get 100 or 150. That's going to cover me for the next 3 or 4 years for my income liability. So, really you look at, okay, how much do I need? What am I trying to cover up? I want to reduce my tax liability. If it's only passive income, then we look, okay, how much passive deductions do you need? You may not need to do it on all your properties and do the look back studies, go as far back from the oldest ones. But the current depreciation can offset the current properties can offset depreciation on all your other properties. Because again, it's all passive income. It's all rental income. So if your Schedule E has, $50,000 worth of income, we just got to go find, okay, let's find $250 to cover you for the next 5 years. And that might be 1 or 2 properties could potentially do that. See anything else? Active K1, my wife wants to be a real estate professional. We probably need to talk more. You've got my information. You can email me or stuff like that here. Yeah, if you're active K1 versus a passive K1, if your wife wants it, I've got a document that I can share that's from the real estate CPA. It just talks about real estate professional and the status. There's a lot of rules there. IRS looks hard at that, but as long as you're spending 51% of your time and at least 750 hours, and you're an active participant in your own real estate, then you can do it. If you're a broker, I think you can use, if you're in the real estate industry, you can use 250 hours of your kind of professional time, but you've got to really be dealing with your own real estate to offset it. Unless, again, you're using short-term rentals, which have gone crazy, and then it's only 100 hours. So that's why the STRs have gone so good. Okay, you'll call me. So. And not tonight. I'm on the East Coast. We'll do that tomorrow. I'll be in the office tomorrow. Let's see. Any other questions that I didn't catch?
I do have a question for you, Bill. This is Elsa.
Hi, Elsa.
Hi. So my question is, can you touch on the depreciation recapture? So let's say if I buy a property this year for $2 million and I flip it next year for say 3, so I make $1 million on the flip. Is it worth it to do the bonus depreciation and then ended up flipping it next year? So how does that work?
Great question, because a lot of people recapture, and on bigger pockets, it's like a 4-letter word. Oh my gosh, we don't want to do it because of recapture. Well, if you're a onesie twosie investor, recapture will get you, because like I said, you're always going to pay that taxes. You're deducting it. A 1031 pushes it down the line. Of course, if it goes when you die, it has to step up in basis for your children. So that's okay. That won't happen. But if you're not taking it to then, those taxes have to be paid at some point once you get out of that 1031. Same with depreciation. So recapture is that. So again, you bought it for $1 million. We do depreciation. We find 25%. So now your depreciable basis is $750,000. You sell it next year for $1.5 million. So your capital gain is not the $500,000, it's 750,000. Now that 250 is taxed at a different rate, but we'll get into details because that kind of gets complicated. But so now you've got a bigger capital gain. So yeah, if you're only buying one property occasionally, you probably don't want to do it. However, you're active. You're buying properties every year. So if you are an active real estate investor and you're buying properties every year, of course you would, recapture is not going to bother you because your depreciation on your new properties is going to offset that one. So again, you're still kicking it down the road. Eventually, tax will come due. But a lot of people will, it becomes tax strategy, But if you're active every year, recapture is not a big deal. And what some people do, instead of taking 100% bonus, if they think they're going to sell it, bonus is an election. So when you put in the software, your CPA puts in there and says, okay, here's your, 27.5 year, here's your 15 year, here's your 5-year property, then you elect 100% bonus on the personal. So instead of taking that $250,000 100% bonus, you might say, I'm just going to take it on the 15-year, or you just use salary depreciation. So you're only using the depreciation over the year. So you're getting more deductions, but not the 100% bonus. So it really boils down to tax strategy. Most people are doing 100% bonus. I've only seen a few since it's been going on that have taken, not taking 100% bonus that I know of, and really for tax strategy, what was going to happen the next year or why they didn't take it. So it again, more of a CPA question, your particular position. But if you're holding it for a year or two and you're selling properties, buying and selling properties every year, you shouldn't worry about recapture because again, your next property is going to offset that capital gain. Does that make sense? Did I answer that properly?
You did. Thank you so much.
Okay.
I appreciate that. And I didn't see my company logo on the companies that's screen share that you put out there. I didn't. I'm just teasing you.
I know. I should have done that.
I don't see it. I don't think I see sunrise.
I have to add that one. We need to get that one. We threw this someday, and I just threw this in with today. I said, today, Alana said, "Oh, great thing," and I said, "Oh, I need to put something in about DIY because I think a lot of the investors are doing rental homes, so DIY is important." And I said, okay. And then I said, I should talk about ELB so you know who we are, so we have some credibility. The reason why I'm here, that we know what we're talking about. And then I said, I just throw in just, everybody recognize that stuff. So there's a little bit of stump preaching there and bragging, I guess. But
yeah, thank you so much, Bill. I don't know if you guys know, but I use Bill for pretty much all of my properties, and the do-it-yourself, the DIY is super affordable because if you buy a $1 million property and you go to, like Madison Spec or something, some of the bigger guy, you end up paying $5,000-$6,000 to do a cost sex with them. Whereas with Bill, you saw the breakdown earlier, it's just much more reasonable. So I use Bill for 4 or 5 or 6 of my properties this year. So, yep.
Yeah, so we've done a couple of DIYs and we've done a couple traditional studies. It depends on the property because they were smaller and it just makes sense. So I help counsel people, and we're bigger than Madison Specs, by the way. Their title comes up too, but from a cost segregation perspective, and they do modeling. They do what DIY does for their traditional study, and it costs more. And they're a good firm. I mean, and Yona's got a great following. He's a great network marketer. But our study, I think, is much more detailed, and our DIY works great and it's very affordable. See, what are the interest tracing rules, and can 250 be used to reduce taxability if you make less than $1 million? I'm not sure I follow it. So 25,000, it was 100,000. Okay. Yeah. Okay. So if you're an investor and you did like a passive investment and you got in a syndication, you got a K1, your first year K1, let's say you got $20,000 in losses year one through pass through in your K1, and you make $100,000 or less. Your adjusted gross income on your tax return is $100,000. You can use up to $24,000 to offset your tax liability. Between $100,000 and $150,000, that reduces down to zero. But I believe it's $24,000, not $25,000. But it's one of those two. And again, it might be different by state. So that's really a CPA question. But yes, you can use that to offset if you have your adjusted gross income is below 100,000. You can use depreciation like a real estate professional can, to offset ordinary income. But once you go over 150, that disappears. And between 100 and 150, it is a sliding scale. It kind of gradually disappears. Hope that answers your question, but that's a rule that's out there. So I've got a client right now. He's got some rental properties. They're not making over $100,000. I said, then you can use the depreciation, because he's not a real estate professional, but he's able to use the depreciation and it will carry forward. So hope that answers that one. I think that's all of them so far. Is there anything I left out?
Any other questions? Speak now or reach out to him offline.
Yeah, I mean, email me, shoot me a message. You want to talk about it. I've got my DIY cost seg. We can talk about that. You go through here and there's a coupon code. My coupon code is 1200. It would save $100 on that one. If you see that, I mean, $50, I'm sorry, goes down $50, $100 on a commercial. And I step people through it. What we do is we'll go through the screen, which I do with Elsa, and then we push the button at the end. And this is going to be nothing because but I say, okay, what number did you get? And she goes, I got, $400,327.14. I said, I got 300,000. Okay, let's go back and check our numbers. Or we got the same number. And I say, print it, boom, submit. You get the report, you're done. Takes about 15 minutes. Usually chat and we answer questions. So it might take a little longer, up to a half hour, but you can go through it pretty quickly. I got people that do this every day. I got people that do, 10 or 15 properties, Sometimes they'll send us a list. We'll do them all for them. So anyway, that's it. I mean, hope I taught some folks some stuff and made some interesting things about cost seg, which is kind of boring engineering stuff, but I get excited about it. I've been doing it for a while. So I've been doing this for 9+ years. Actually more than that, because when I was the first American, we bought a company in the tax group that did this, and I represented a few big deals on that too. But I didn't know what I was doing. I was brought in the president of that division and save big companies money. So
awesome. So needless to say, you've been doing this for a very long time and you're not really sure for how long, but we know that you're a professional and that you answered everybody's questions very detail oriented and eloquently. I appreciate that. We appreciate you being here, Bill. This has been a pleasure. You're a lot of fun and you make fun of what could be a boring situation.
Yeah, well, I try. I do my best and it's fun. So yeah, just reach out to me.
Thank you so much, Bill.
Thanks for having me. I hope people learned something here. And again, if there's anything I can do to help, just reach out to me.
Perfect. Thanks, everyone.
Well, that concludes our webinar with Bill Smith, aka William Smith with ELB Consulting. You can reach him at elbcostseg.com if you have any cost segregation needs or questions. I hope that you enjoyed that and found some value in it and you're able to save money this tax season. It's right around the corner. We're in the thick of it. So best of luck. I hope you can plan ahead. If you didn't last year, then for this year. If it wasn't already mentioned, I just want to touch on, if you are interested in passively investing in syndications, you do get the benefits of these cost segregation studies, and you do get to apply those tax benefits to your own taxes. So reach out to me if you have questions on that or you have any interest. If you're interested in future webinars, you can sign up at clearconnectioncapital.com, where I will blast out any upcoming webinars. This year, I plan to do them quarterly. So check that out. You can also sign up there to get investor updates if you'd like to learn more about investing with me and Clear Connection Capital. If you are so kind and enjoying this show, please leave me a 5-star review on any platform that you're watching. I would greatly appreciate it. And it helps me reach more people. The algorithm likes that. So, follow, like, subscribe, share this with anybody that you think would be open to saving money this tax season and invests in real estate or is thinking about investing in real estate. Also, you can reach out to me on Instagram anytime, AlanaGeorge_real estate, or go to the show's website, obsessedwithrealestateshow.com. I think that's all. Thanks for watching and listening, and I will see you on the next show.